Larry, give us a sense of this decade that's just happened. A big run-up in the markets, particularly equity. What drove that?
Part of what drove it was how weak the markets were at the beginning of the decade as a consequence of the financial crisis. Part of what drove it was we had the longest recovery we have ever had. But crucially, what drove it was that interest rates fell so low that people applied a much lower discount factor to future earnings, and that inflated the price of all assets, whether it was stocks, whether it was real estate. Anything that promised future cash flows became more valuable as interest rates came down.
So, Roger, that raises the question, obviously, of are we inflating asset values through lower interest rates?
So, look, I agree with Larry that, without a doubt, the big driver was the move in interest rates, both here and around the world. Question of are we inflating values, I think it's too strong to say that. That implies some massive bubble that's about to burst. However, what we have seen, David, is that the PE multiples have started to increase as well, which is suggesting that every dollar of earnings is getting a bigger and bigger return. So I'd be a little cautious on the word inflating, but I agree completely with Larry that low interest rates were the major driver for markets.
Is the market overbought when it comes to equities?
I don't think it's clear that it is. I think that given what's happened to interest rates, which in my view is heavily driven by real events in the economy, more saving because more of the money's going to affluent people, less investment because the price of capital goods has come down so far. I think those are the reasons why you have lower interest rates. And when you have lower interest rates, you have higher multiples. I'm not sure that it represents some fundamental imbalance. This certainly isn't a moment like the moment at the beginning of the decade when markets look cheap. And I think we've got to recognize that because interest rates are much lower and maybe risk premiums are the same as they always are, that returns going forward are going to be substantially lower than they have been over the last decade.
And that is the question. If low interest rates and starting from a low base drove the last decade, what's going to drive the next decade?
I think it's going to depend on the news, and we don't know whether the surprises are going to be positive or negative. But I think if things work out as everybody expects them to, then you're going to be looking at equity returns that are much lower than people have become accustomed to over much of the last generation. My guess would be that if you invest your money in part in stocks and in part in bonds, you're going to be looking at returns perhaps in the 5-6% range, which is much lower than people experienced over the last decade. And that's probably going to be an unpleasant surprise for some people.
So, Roger, you're responsible for a lot of money, for a lot of pensions. People are going to count on that money over the long term. What is that thesis that Larry set out? What does that tell you about investing?
Well, first, a point I would have made that I didn't hear Larry make, the thing that's going to drive markets over the next several years is what's driven them in the last several. First question is, are interest rates going to remain low, right? And so the expectation that the Fed and other central banks will be on hold for a period of time, I think is going to continue to support equity valuations and other valuations. I think Larry's absolutely right. The return that the average investor can expect in equity markets over the next 2, 3, 5, maybe 10 years is going to be somewhat lower than we had in the past. That does not mean that it's going to sort of burst. It does mean that one should expect slightly lower returns. The answer to all that, though, when I think about pensions, is you want to have broad diversification. And so equity, fixed income, but certainly alternatives will be another place to look. And then you're going to want to play the big global themes as well.
Larry, what do you think? I mean, one of the things that strikes me in the last 10 years is there's a delta. They've been cutting interest rates. Is just static low interest rates enough?
That's the key point. Roger's right about diversification. Roger says they're going to be slightly lower over the next decade. I think it's going to be a good deal more than slightly lower. I think that people will do fine if they earn 5 or 6% on their money. I think that people are going to realize that it's not going to be the kind of happy decade that we saw. I think the happy decade came in part from the positive surprise of falling interest rates. That drove up bond prices definitionally, and it drove up stock prices because falling interest rates meant higher multiples. We might see continued low interest rates, but there isn't that much room for interest rates to fall starting from a 10-year of 1.8. So I don't think it's going to be nearly as bullish a period over the next decade as it has been in the last. And since the level of interest rates is a kind of fundamental determinant of everything, I don't think that, I think diversification is absolutely the right strategy, but I don't think people are going to be able to avoid the reality that returns are going to be lower in the future than they have been in the past.
So I don't fundamentally disagree with Larry's point. And, is it going to be a 4, 5, 6% return? Certainly not going to be the 15, 20% or almost 30% that we saw in 2019. So I think we can agree with that. The other couple of questions we have to come to grips with as we think about this is what's going to happen with corporate earnings, right? And that was another driver. And to be fair, they still look healthy, but not outrageously so. But we're going to have a view about that for the next several decades. And the other thing, David, I think we have to think about is let's start talking about markets overall and start to think about different parts of the market, right? So there are going to be some themes that are going to look very exciting as we
Such
think.
as?
Well, think about what's happened at the beginning of this year. The FANG stocks have continued to take off. Some of them have hit record highs. Are there more opportunities in technology that have yet to be unlocked? And so I think it's going to be important for the investor to stop thinking about the market overall, for reasons that I think Larry makes really good points. And let's start thinking about what are the big trends and what's likely to be the winner going forward. And that's one of the reasons that many people think that the next decade might be a period when active management and stock picking comes to the fore as opposed to
the last
what's
decade
happened.
certainly wasn't that, Larry.
Certainly was
It
not.
was all passive.
Roger's much more optimistic about active stock picking. There may be some hedge funds who make some money in active stock picking. There'll always be a few managers who outperform. But I think your listeners would be making a serious mistake if they were to think that they were going to consistently outguess the market. And I think I'm probably a little less optimistic than Roger is about corporate earnings, whether it's bipartisan agreement on the need to regulate pharmaceutical prices or increasing enthusiasm coming from both political parties for increased regulation of technology, or a growing sense of the need for more environmental regulation, or a sense that, if anything, we've gone too far on corporate tax cutting and that might get reversed. All of those things say to me that the public policy environment, which in many, many ways, particularly since President Trump came into office, has been a big tailwind for corporate earnings. I think corporate earnings are going to hit a variety of headwinds, whatever happens to the overall economy going forward. So I'm less optimistic, and yeah, there'll be some areas of the market that will outperform, but whether we're going to be able to pick those in advance, I'm not nearly as optimistic about that.